Welcome to The Explainer. Today we're taking complex academic finance and turning it into a real, actionable playbook for your portfolio by exploring the legendary formulas of Benjamin Graham. If you've ever felt completely overwhelmed by the sheer noise of the stock market, well, you're in the right place. We're going to use real historical data and foundational math to cut straight through that noise and find actual value.
Here's our roadmap for today. We'll be hitting the value investing playbook, the Benjamin Graham number, calculating intrinsic value, valuing the banking sector, and finally, active versus passive returns. Let's get right into it.
Section 1. The Value Investing Playbook. We're starting off by contrasting the wild anxiety of modern market momentum with the cool, calculated logic of the father of value investing himself, Benjamin Graham. Graham and David Dodd came up with this core philosophy back at Columbia Business School in 1930, and it's brilliantly simple. You buy securities at a discount to their intrinsic value. It's all about screening for undervalued stocks using sound company fundamentals, completely ignoring whatever the emotional ticker tape is screaming on any given day.
All right, Section 2, the Benjamin Graham number. This is where overarching theory turns into strict, measurable math.
The Benjamin Graham number is a fantastic metric because it acts as a hard ceiling for your purchase price. By heavily weighting a company's profitability, its earnings per share, and its net asset value through book value per share, it essentially forces a mathematical margin of safety right into your buying decisions. You literally never overpay for what the company actually owns or earns. Now check out that massive constant in the formula, 22.5. Where does that exact number come from? Well, it cleverly combines a maximum acceptable price-to-earnings ratio of 15 with a max price-to-book ratio of 1.5. Graham believed that if a stock exceeded either of those thresholds, it was just too expensive for a defensive investor. Multiply 15 by 1.5 and boom, you get that magic 22.5 baseline. When we piece it all together, that's the square root of 22.5 times EPS times book value per share, we get an incredible formula for stable, asset-heavy industries like manufacturing. But, and this is a big but, it completely ignores future growth potential. That makes it kind of like a blunt instrument for today's tech sector, where future earnings matter way more than physical assets. Moving on to Section 3, calculating intrinsic value. So if the Graham number is too rigid for fast-growing companies, how do we adjust without losing that all-important margin of safety?
Well, by 1974, Graham actually revised his formula to directly factor in expected growth. That's the 2G you're seeing here. But the absolute stroke of genius? He introduced Y, the current AAA corporate bond yield. This brilliantly captures opportunity cost. As safe, reliable bond yields go up, the intrinsic value of risky stocks mathematically goes down. It keeps you completely grounded in reality.
Section 4. Valuing the banking sector. This is where we transition from abstract theory right into real-world application.
Financial institutions are notoriously tricky to value because defining debt and reinvestment for banks makes traditional discounted cash flow models a massive headache. Analysts rely heavily on relative valuation methods like the price-to-book ratio. For banks, whose assets are mostly liquid, book value is a much more reliable, tangible anchor than it would be for, say, a software developer. Let's look at a concrete, historical example. Applying Graham's revised formula to Bank of America reveals a truly staggering swing. Look at this. A jump in EPS from just 3 cents during a depressed 2011 up to 98 cents in 2012. Skyrocketed its calculated intrinsic value from roughly 70 cents to over $23. This just shows how sensitive the formula is to earnings turnarounds, letting a patient investor spot extreme undervaluation way before Wall Street catches on. When we compare top-tier bank holding companies, Bank of America sits perfectly within Graham's classic defensive thresholds, sporting a PE ratio right under that magic 15. Meanwhile, JP Morgan is hovering on the edge and Morgan Stanley is sitting even higher. This quick fundamental check instantly helps you zero in on where the hidden value actually lives in a sector.
Section 5, active versus passive returns. For our final act, we have to answer the ultimate question. Does doing all this fundamental math actually beat just buying and holding an index fund?
Let's pit a fundamental analysis portfolio, built purely on Graham's intrinsic value models, against a totally passive strategy that buys and holds, ignoring risk management and timing altogether. It's the classic showdown, active stock picking versus the passive conveyor belt.
When applied to massive Dow Jones components between 2014 and 2020, the value investing approach generated dramatically higher returns. Just look at Apple. It delivered a 64% return under the value framework compared to just 25% passively. Home Depot and United Health showed similarly massive, verifiable outperformance when bought at a calculated discount.
Looking directly at the empirical data for the whole Dow Jones portfolio, the mean return for the intrinsic value model was an incredible 31%. I mean, that absolutely crushes the 14% return of the passive strategy. The statistical significance here is just undeniable. Methodically refusing to overpay generates a massive premium.
And you know what? These results aren't just limited to the US market. When Graham's formula was adjusted for India's fixed deposit rates to account for local opportunity cost, the value strategy outpaced the passive Nifty benchmark by nearly double, scoring over 24% against a mere 11%. The laws of financial gravity really do apply worldwide.
So what does this all mean? The math proves that value investing works. But are you willing to put in the deliberate work to find those hidden gems? Will you keep relying on volatile, emotional market momentum, or will you anchor your next investment with Benjamin Graham's mathematical margin of safety? The data has spoken, and the playbook is yours to use. Thanks for exploring the numbers with me here on this explainer.